Okay, for several of the securities licensing exams, SIE 7, 65, 66, you may be asked questions that deal with how to calculate gains and losses on an exercised option. Okay, so what I'm going to do here is run through the process for how you would go about figuring out and answering one of those questions. So first off, before we get to that, let's just go over a little bit of sort of background, what an option is. Remember, an option is basically a contract between two parties that gives the buyer of the contract the right to either buy or sell an underlying asset to another party at a designated price called the strike price. If somebody buys a call option, it means they have the right to purchase the underlying security at the strike price. If somebody buys a put option, it means they have the right to sell the underlying security at the strike price. Okay, so now when you're going to go about calculating gains and losses on exercised options, you kind of need to understand what's happening in an options contract. Okay, so when an option is exercised, that means the option holder decides to either buy or sell the underlying security at the strike price. Remember, if it's a call option, the option holder has decided to buy the underlying security at the strike price. If it's a put option, the option holder has decided to sell the underlying security at the strike price. So that means when a call option is exercised, the option holder purchases those shares at the strike price. When a put option is exercised, the option holder has to go out and buy those underlying securities at their current market price and then sell them at the strike price. Okay, so let's go through each of these. Let's look at buying a call option, how to calculate gains and losses, buying a put option, how to calculate gains and losses, and then on the other side, the investor who sells a call option, how do you calculate his gains or losses? The investor who sells a put option, how to calculate his gains or losses. All right, so first off, let's look at a call option. Let's look at a call option and a long call option. If somebody is long a call option, that means that they are the option holder. Okay, so when a long call option holder exercises their option, what they do, as I said before, is they purchase the underlying shares. Okay, so now when they're calculating gains or losses, they need to, you would need to determine how much did they purchase those underlying shares for. Okay, so the price of the underlying shares for the exercise call option. All right, trying to write here. Then you also have to remember that in order to buy the option in the first place, they have to pay a premium. Okay, so you would also add the price of the premium, right? The amount basically that they paid to buy the option. Okay, so these two things here represent money out. This is money that they've spent, money that's come out of their own pocket, if you want to look at it that way. Okay, now they exercise the call option when the price of the underlying security goes above the strike price on the call option. Okay, so then they exercise the call option by purchasing the underlying securities at that strike price, which is going to be lower than the market price. And then for many of these questions, they will tell you that they turn around and sell it then at the strike price that's higher. So the money that they would receive in one of these scenarios is the money that represents the market price of the securities. Okay, so they buy it at the strike price, then they turn around and sell it at the higher market price. So they take in that money that they receive at that point. Okay, so that's money in. So when you're calculating the gains or losses on a long call option, you basically take money out on one side, the money that they spend, and money in on the other side. And you basically figure out the difference, right? If the money in is more than the money out, they make money by whatever amount. It exceeds the money out. If the money out is more than the money in, they lose that amount of money. All right, so let's look at an example here. So Marie pays $200 in premiums to purchase a call option with a strike price of 20. She then exercises the option when the underlying stock is trading at 25 and sells her shares at their current market price. So what is her gain or loss? All right, so let's just make a table, which we often call a T-chart. A T-chart is basically a two-sided chart. You put money out on one side and money in on the other side. And then you basically just do your subtracting. All right. So what do we put on each side? So she pays $200 in premiums. Okay, so money out right off the bat, you've got $200. I'm going to write it represents premiums. All right. All right. So the option has a strike price of $20. So when she exercises that option, that means she's going to pay $20 a share because she's going to purchase the underlying securities. Now there are 100 shares in an options contract. So she pays $20 a share for 100 shares, and you've got $2,000 that she spends as a result of her options contract. $20 a share for 100 shares, $2,000. Okay, so I'll write the cost. The cost equals strike price. Okay, so she has spent $2,200 for her $2,200. All right, so then she does this all. She exercises the option when the underlying stock is trading at 25, and then she goes out and sells the shares she just bought at their current market price. When she sells those shares at their market price, that's money she takes in. $2,500 equals money in. 25 a share times 100, and this is the sale price. All right, so now all that we're doing is we're looking at the money in, and we'll look at the money out as a minus because it's money she spent. $2,500 minus $2,200 equals a $300 gain. That is supposed to be a dollar sign there. Sorry. So that's it. That's your answer. She's got a $300 gain as a result of her long call options investment. Okay, let's look at what happens when somebody buys a put option. So I'm just going to write buying a put right here. Okay. So remember, when somebody buys a put option, basically what they do is they have purchased the right, or they've taken on the right to sell the underlying security at the strike price. So they hope that the market price of the underlying security drops below the strike price, because if it does so, they can go and buy those shares at their current market price and then sell them to the option seller at the higher strike price and make money that way. Okay, so when we're calculating gains or losses on a put option, we have to remember that when somebody goes long any option, they pay the premium. Okay, so again, what we're going to do is we're going to compare the amount of money out of their pocket, the amount of money they pay, to the amount of money that they take in. Okay, so when we're talking about money spent, I'm going to just call it money spent this time instead of money out, same deal. The premium, first off, the amount that they spend to purchase the option. All right, the other thing that they're going to spend money on an exercise put option, they're going to have to go out and buy 100 shares of the underlying security at its market price, because you've got to own the security before you sell it at the strike price, right? So they're going to go and buy that 100 shares. So the second part of money spent is the cost of the shares, and that's going to be their market price. Because remember, they would only exercise their put option if that market price fell below the strike price. Okay, so when it does that, they go on and purchase them at the market price. And then we get to money in. So now they have gone out and purchased those 100 shares of the underlying security. They sell them to the option seller at the strike price. Okay, so the money in is basically the strike price, the amount of sale, the money received for the sale. For sale of exercised shares. It's an exercise option, but I'm talking about the shares within the exercised option. So the money spent or the money out is going to be the premium and what it cost them to purchase those securities at the underlying market price. The money in is going to be the money they receive when they put those shares to or sell them to the option seller, who is obligated to buy them. Okay, at the strike price. All right, so let's now look at an example. Pierre pays $300 in premiums to purchase a put option with the strike price of $30. When the market price of the underlying securities drops to $25, he purchases 100 shares and exercises the option by selling those shares to the put seller at the strike price. So how much is his gain or loss? All right, so let's put money in on the left again. Let's do our kind of informal T-chart here. Sorry, money out on the left, and then we'll do money in on the right. All right, money in on the right. All right, so money out, he pays 300 in premiums right off the bat, right in the first phrase of the prompt. It tells you that. So $300 out. That's premiums. Now, when the price of the underlying securities drops to $25, he goes out and purchases 100 shares at their market price. So he's spending that. $25 a share times 100 shares. All right, so that would be $2,500, right? And this is the money he spends to purchase the underlying securities. I'm just going to write purchase underlying there. So now what you've got is on the left, he has basically, he's got negative $2,800. He spent $2,800. You're adding that premium to the money he spends to purchase the underlying. Okay, so now the option has a strike price of $30. So when he exercises it, that means he is selling those shares to the option seller at that strike price. So when he sells them at that strike price, that's the money he takes in. It's going to be $3,000, right? 30 times 100 shares. Okay, so that's basically the strike price. All right. So now again, you've got your money in, $3,000 minus the $2,800 that he spends. We've got another positive result here. We've got a $200 gain as a result of his options transactions. So far, we've had two positive gains. It certainly doesn't always work that way, but we're making up the examples. We can try to be positive. All right, so now we're going to shift our attention to something a little bit different. When somebody sells an option, right? So for every option, remember, hopefully you've learned this. There's a buyer and a seller. Okay, so we've talked about from the buy side, the long side so far, but on the other side, when somebody shorts an option, that means they sell the option to the option holder. Now, when somebody shorts a call option, it means they sell that call option to the option holder, and if the option is exercised, if the price of the underlying security goes above the strike price and the option holder decides to exercise the option, that means the option seller, if they don't already own those shares, is going to have to go out in the market and buy those shares for their market price, which is going to be higher than the strike price. That's why the option was exercised in the first place. Now, remember, the option seller has already taken in the premium, right? When they sell the option, they receive that premium. Okay, so they've taken that money in. Then they have to go out and buy the underlying shares at the market price. So that's money they spend. And then they turn around and sell those shares to the option holder. So they also would take in the strike price. All right, so now we're talking about shorting a call option. So the money in, I'll do money in first here. Money in is going to be the premium that they receive when they sell the option, plus the strike price that they receive when the option is exercised. Remember, again, when a call option is exercised, the option holder is buying the securities at strike price. So that means the option seller is going to receive what the option holder pays to buy the securities at strike price. So that's money in, the premium plus the strike price. Now, money outs is going to be the amount that they have to pay to go out and buy those underlying securities at the market price that they're going to then turn around and sell to the option holder. So the market price, the purchase price of underlying securities. And remember, that is going to be the market price. So I'll write market price in parentheses. All right, so then all you do is you just compare the money out to the money in, and you determine gain or loss. So let's look at an example here. So Michael shorts a call option and receives $500 in premiums. The option has a strike price of 50. When the underlying shares are selling at 55, the option holder exercises the option. So Michael purchases 100 shares of the underlying stock at the market price. then sells those shares to the option holder at the strike price. So how much does he gain or lose? All right, so let's make our T chart again here. So money out on the left, money in on the right. You could flip it and do money in on the left and money out on the right. It doesn't really matter. The T chart is just really a way for you to help you visualize where you're putting these amounts. All right. So let's you know what? I'm going to start on the right this time, okay? Because the first thing that happens is he receives money. So let's start on the right. So money in. So he shorts the call option and receives $500 in premiums. All right, so that's 500 the premiums, right? He takes that in. Okay. So now the option has a strike price of 50. So when it's exercised, that's the amount of money Michael's going to receive because he's going to sell the shares that he goes out and buys for that strike price of 50. So he takes in that money. So he takes in 50 times 100 shares. There's 100 shares in an options contract. He takes in $5,000. The strike. I'm just going to put strike price in parentheses. Now, before he's sold those shares for $50 a share, he's had to go out and buy them, right? He has to go out and buy them at their current market price of $55 a share. So he's got to go out and spend $55 a share times 100 shares. So $5,500. So he spent that. That's the market price. Looks like we've got a match here. Looks like the money out, $5,500, is going to be the same as the money in, $5,500. So it looks like in this case, Michael has a wash, 5,500 minus 5,500. So no gain or loss as a result of his short call option transaction. All right, last thing to look at now. Let's look at what happens when somebody shorts a put option. So a short put option. All right, so when somebody shorts a put option, it means what they do is they sell that option to the option holder. They take in the premium. The option seller takes in the premium. Now, what a put option does, again, we said this earlier, but it gives the option holder the right to sell those securities, the underlying securities, at the strike price. Okay, that means that the short option investor has the obligation, if the option is exercised, to buy those shares at the strike price. All right. So then a put option would only be exercised if the market price of the underlying securities went below the strike price, right? That would be when the option holder would exercise it, because he can go and buy them at the market price, which is lower than the strike price, and then sell them at the strike price and make money that way. So now we're looking at it from the short put option investor's perspective. Again, we have to look at money in and compare it to money out. Okay, so I'll look at money in first. The money in is going to be the premiums received, right? He shorts the option and receives the premium. Okay. And the other thing that he's going to take in. So in many of these questions, the prompt is going to tell you that the option is exercised. So the short put investor has to go and buy the underlying securities at the strike price, and then he immediately turns around and sells them at their market price because he doesn't want to hold on to the securities. So for a question like that, and those are the common questions you'll see on the exam, he is also going to take in the market price that he receives when he sells the securities. Usually the question prompt is going to tell you, the option's exercised. So the short option investor buys them at their strike price and then gets rid of them at their current market price. So when he gets rid of them at their market price, he takes in that money from the sale. So then the money out, we've looked at money in. The money out, the money he pays is when the option's exercised. That means he has to buy those 100 shares from the option holder. So it's going to be the strike price. The strike price paid. All right, so then you would compare money in to money out and determine gain or loss. So let's look at our last example here. All right, let's look at an example of gains or losses when somebody shorts a put option. So Maribel shorts a put option and receives $400 in premiums. The option has a strike price of $40. The option holder exercises the option when its underlying stock is trading at 35. Maribel must purchase 100 shares of the underlying stock at the strike price. She then sells the shares she's purchased at their current market price. So how much does she gain or lose? All right, so let's do our T chart again here. Let's do money out on the left, money in on the right. All right, so first off, it says she shorts a put option and receives $400 in premiums. So that's money in. Okay, so the other money that she's going to take in, when the option is exercised, she needs to go buy those shares at their current strike price. And we'll get to that in a minute. That's going to be money out. Then when she buys them, she owns those shares. She turns around and sells them at their current market price. So their current market price is $35. From this question prompt, it tells us that it's exercised when they're trading at 35, and then she sells them at their current market price. So from what we know here, she sells them at $3,500. That's the market price. So she sells them, she obviously receives that money. So the total amount of money she receives, $3,900. So her total money in is $3,900. Now, when the put option is exercised, that obligates Maribel to pay that strike price to buy the underlying security. So that's going to be money out. She pays that money. And that's $40 a share. So she pays $4,000 total. So that's the strike price. I'm going to treat this as a negative because it's money out. So now you've got $3,900 that she's taken in minus $4,000 that she has gone out of her pocket. So we have a loss here. We have a $100, negative $100. So we'll call it a $100 loss. And that's what Maribel ends up with as a result of her put option, short put option investment. Okay, so remember, when you're calculating gains and losses on exercised options, the most important things to understand what happens in these transactions, right? A call option is exercised. That means the option holder is paying the strike price for those underlying securities. He's already also paid the premium to buy the option. Now he can turn around and sell those shares at their current market price. So that'll be money in, the money he takes in when he sells them. The money out will be the strike price and the premium. For somebody who has a put option, that gives him, that option holder, the right to sell the underlying shares at the strike price. Okay, so that will be the money he receives. He sells those underlying shares at the strike price. Now he's going to have to go out and purchase those underlying shares to own them in order to sell them. So the purchase price is going to be money out, and the premium that he paid is also money out. Okay, when somebody shorts an option, either a call or a put option, they always take in the premium received. Now, in the case of a short call option investor, if the call option is exercised, he's going to have to go, assuming he doesn't own the shares already, going to have to go out and purchase them at their current market price. So that's going to be money out. Then he'll receive the strike price when he sells them to the option holder. So his money in is the premium, and the strike price is money out is the market price he pays. And for a put option short investor, that individual is going to have to pay the strike price to purchase the securities from the option holder. And then in most of these questions, they're going to tell you he turns around and sells them at the market price. So he's going to take in that market price, and he's already taken in the premiums. So the difference between money in and money out. So understanding what happens in one of these transactions, and then simply doing your T chart, money in, money out, calculate gains or losses that way. So if you understand this process, you see questions like this on one of your exams, hopefully you're able to run through this and get those questions right. Okay, hopefully this helped. Take care.